Welcome to the Airmere Trading Group 1 meeting. Today is the 15th of February, 2021, day after Valentine's Day. So hope everybody had a good weekend. And today is the observing President's Day, so Washington's birthday. So markets are closed, so we may have a little bit of a light turnout today, which is okay. Hopefully everybody who's not here is enjoying the time off. I did want to share something. Wayne Klump does a nice weekly commentary, and Wayne, you're here, so you jump on and say whatever you like here. But we're going to have this weekly commentary available for people for 4 weeks, and I have a link for people to sign up for it. But it's pretty good. I know, Wayne, you've had some good comments from people about your commentaries that you do. Maybe you want to take a minute and talk about it?
Oh, sure, Tom. Yeah. So it actually all started off with just there were questions about the sleep well portfolio, and there were questions about kind of the methodologies and how I came up with things, and kind of just what's the macroeconomic background, and then even what is macroeconomics, right? And so I just kind of started on a weekly basis, just a little minor update of just kind of what's going on, what the backdrop is, things like that. Kind of what we would do on kind of like a monthly meeting, like or a weekly meeting, like what we do, and then the monthly meetings we go significantly deeper into things. But yeah, I mean, a lot of subscribers have really enjoyed what I wrote. Or what I'm writing, and it's been informative to them, and so I've kind of kept it going. And um, sometimes I elaborate on just different viewpoints on anything from Bitcoin to commodity pricing to inverse relationship to U.S. dollar to emerging markets. And then I think one of the last ones that we wrote was how small caps and oil correlations through large trends happen. And so certain things that just things that I notice, and I would just like to share. And some people have really it's resonated with some people, and it's helped some people see some relationships in the markets that maybe they previously didn't. And so the feedback's been great, and so I'll keep it going, and it's part of the service now.
Yeah, and if you don't want to do the whole sleep well service, you can take a look at the market commentary and get a feel for it. It's a nice chance to see what Wayne's writing and see what underlying things are actually affecting the market. And I guess that's kind of what you're using for your yardsticks to decide what's risky and what isn't, and how to move in and out of things, right?
I mean, we definitely use correlations and relationships and volatility measurements across assets and things like that to pull out what the relationships are and where the risks are in the market. That's what the Sleepwell does. And more so of what the commentary does is, hey, what's the general what's generally affecting certain things, or even sometimes people will ask about why don't we have commodities in the Sleepwell portfolio. And then that's when commodity indexes or commodity ETFs, which have normally a very heavy exposure to oil. That's when that correlation. That's when I started displaying that correlation with small caps. And since we already have small caps, then the diversification really isn't there. So adding an extra asset isn't worth it. And so we kind of go into all of those little aspects from time to time. And sometimes the commentaries are relatively light, and sometimes they're a little bit heavier. And sometimes they're aimed to a more like a newer investor, and then sometimes they're a little bit more towards the advanced. I know, like, my wife is like, yeah, that sounded like a foreign language to me. So I probably wouldn't say that it's like for the completely novice, but if the novice is attempting to build up their knowledge, it's a good place to start. And there's always Google search and things like that. I really do try to write it in a just kind of a more of a simplistic nature, instead of uh, kind of going into like professor speak and super mathematics and things like that. More of just generalities. I normally don't get into like what is the exact correlation coefficient and what's the correlation coefficient variances through different, through um, uh, different regimes and stuff like that. I don't get into those types of heavy things, but we definitely stay with like just the general concepts of the market so that we can have like a surface level what's going on that's stripped away from like the news type of commentary where it's just talking heads and type of stuff. We do actually, I tend to look at things in like a quantifiable manner. And so if I can't, if I can't make a data driven decision on it or see how a relationship could affect another through some sort of macro lens, then really it doesn't quite make sense to me. So like, a lot of, I've had a lot of people reach out about politics lately, and I haven't been able to I haven't been able to find anything that relates political unrest in the United States to market direction, although it does have an effect on market volatility. So if like we're, you know, playing volatility, that's a different thing. So political unrest does typically create sustained high levels of volatility, but that's a correlation. But that's maybe a topic for another time and maybe an article that I'll write eventually. But just things like that.
And we got this new information page up, and I really like this chart with the sleep owl versus the spiders. And I noticed, and we talked about this offline. Typically, when the spiders in the last 3 or 4 months, when the market's been going up, the sleep owl's been going up a little bit more and pull back pretty close. But um, that's would you say that's fairly typical where it generally outperforms, but there are cases where it doesn't?
Yeah, that's a great question. Definitely in higher volatility, typically the sleep well portfolio will outperform. Not necessarily since there's something special in it or we're trading volatility or something like that. It's just that it's highly probable that we get concentrated in small caps and emerging markets during high volatility because of how some of the relationships start to affect each other, especially when the U.S. dollar uh, is being inflated hard against other currencies, right? So the relative inflation to other currencies is high. So we can get an outperformance in emerging markets and small caps using that relationship, and that's what we've definitely been seeing over the last few months, versus the SPY, which is more of global stocks. So that's why we've had this outperformance, and that's really really common during these types of environments. And then there will be an environment in the future where uh, global companies and large caps will have their heyday, and we'll have a little bit more concentration in them. And then it'll even get into another environment where we'll have like a strengthening dollar, and maybe even a miracle will happen, and bonds will actually start to go up in value as yields drop. I doubt that we're going to see that anytime soon, but we might see some waves of it. And something like that, then the Sleepwell portfolio will diversify using those assets because of that relationship, because it does have some susceptibility to certain assets dropping and things like that. And we can actually take our risk away from equities. And so sometimes that diversification, albeit it smooths out the equity curve and creates some substantial safety, so it's kind of like proactive hedging. It can allow large caps to outperform us in the short term, especially if they don't have a correction. So that happened in like 2017, where large caps just really, really went to the moon, and the sleep well portfolio was relatively diversified during that time, and and it just outperformed us. So it can cut both ways.
But I really like the drawdown charts that you sent. If I can blow this up a little bit more. This is Sleepwell versus the spiders. I really love this chart, especially over here. What's that, 2008 time frame? That's just
Yeah.
ridiculous.
Yeah, I mean, when we use when we use macro relationships to make diverse investment decisions, we can get a very consistent risk profile. right? And so, and this just kind of comes back to um, the nature of proper risk management through every year, is that the risk management is capped off at certain levels, right? We take only certain amounts of risks in certain environments and things like that. And so that risk is very consistent through every year, right? Um, and so, yeah, I think the largest drawdown in here, probably
I
just
think
over.
Sleepwell's about just over 10% looks like.
Yeah, that's with no slippage in it or anything like that. So that's, executing on the day of. If you end up lagging for a few days, I think you can exceed that by maybe 1%. I think is what the data says. So it's really not that big, even by lagging the allocations for a few days. And sometimes you can actually outperform through using a couple days lag. So yeah, it works really well. I mean, you can definitely see that there are times where we take drawdowns at the same time. So something that I always that stays back in my mind was 2015. Even though the sleep well wasn't really heavily invested in equities, we just had assets in general were actually just selling off. So
Guess
this
that's
is
like
a
this area.
Yep, yep. I mean, we're a long only portfolio. It's designed that way for, like, retirement accounts or investors that don't have short positions and things like that. And so that's the reason why it's long only. Now, it's a beautiful thing that it's long only, because then that means that it's not necessarily um, a tight edge that we're trying to capture. It's just asset growth in general, and that's pretty much the global name of the game. So anyways, you can tell here that, like, we started rallying before the bottom in stocks in 2015 going into 2016, and that was just because the bond push and some of the other assets that we were in that gave us that buoy. So things like that. 2011 was another example where we were hitting new highs as the stock market was selling off, but then the Sleepwell portfolio actually started selling off from those new highs, and so it shows that we took a drawdown as stocks were rallying. So things like that, it's just very uncorrelated sometimes, depending on what assets we're in.
But I really like those drawdown charts. Those are great.
Yeah, I love that you put them up there. That's awesome, Tom.
And then the classic 60/40, 60% bonds or stocks for 40% bonds. That I don't know when that started. That was a long, long time ago.
Oh, you're talking about the 60/40 portfolio, like the Jack Bogle approach?
Yeah, this is a comparison of the two.
Oh yeah, that's I think the beginning of that is mid
2008.
2007.
Yeah,
Yeah. And yeah, I mean, 60/40 is a great portfolio. There's nothing wrong with a 60/40 portfolio. I personally don't like the risk that a 60/40 portfolio has in economic contractions, and that's why the Sleepwell was created. Because when we have bonds get pushed down to really lows, like what we have now, um, then bond prices, which move in opposition to bond yields, actually stop going up as the economic contraction continues. So if we do get business growth slowing and bond bond yields are already at zero or near zero, and the Federal Reserve stops pushing bond yields, then they can correlate. And that's what happened in the 60/40 portfolio back in like 2008. It's also what happened in even COVID, right? Where it offset a little bit of risk, but in the grand scheme of things, it really didn't do much after the initial push, right? And so that's why, moving into some of the other cycles of what the Sleepwell portfolio does, which I'm sure, Tom, I don't know if you have it on this page yet. Do you have the 4 cycles of macroeconomics on here?
I
The
don't.
Okay, growth and inflation. Yeah.
If you have
So
something you want to share, I can let you share your screen.
yeah, I mean, I wasn't quite prepared this morning for that, but I mean, I can definitely share it with you, and that way we can get it posted. But yeah, the
We just talk about it.
yeah. So there are 4 primary macroeconomic cycles in relation to 2 variables, right? So the first variable is inflation. So you have either inflation rising or you have inflation slowing or maybe even deflation, right? Um, and that has an effect on asset prices. So like we can just make a quick example. If we have say a Big Mac, right? This is kind of funny because the economists talk about the Big Mac index, but um,
Guns and butter, right?
yeah. So say we have a Big Mac, right? And if we have if we buy it before inflation, then say it's a dollar, right? Fantastic. Well, let's say inflation over the next, 10 years has been rising and it's high inflation. Well, and say it's doubled in price, right? So that same dollar, right? If it can only buy you a half a Big Mac now. So now you've got to have $2 to buy a Big Mac, right? So what that does is if you're saving, right? If you're holding dollars, if we're holding dollars, it's losing value at half of its value every 10 years, right? And it's probably a little bit faster than that most of the time, but I won't get into all that. And so what ends up happening is holding cash is detrimental to uh, building wealth over time, right? So just holding really the name of the game is to buy assets, right? Because if you buy an asset, so let's say that we are the Big Mac owner, right? So let's go the opposite way. So we're not the Big Mac buyer anymore that's holding cash and waiting to 10 years and then buying a Big Mac later. Say we're the Big Mac seller. So we own the Big Mac and we say, hey, look, we're not going to sell it today for a dollar. We're going to hold on to it for 10 years. Well, then 10 years later, we can sell it and now it's still a Big Mac, right? Nothing's changed in the Big Mac, right? It's still going to just feed one person. It's a Big Mac, right? There's no difference in it. But 10 years later, we can sell it for $2. So we kind of, quote unquote, made money, right? We made a dollar for 10 years, which is just that's the inflation aspect. Now, it doesn't actually buy us any more um, real purchasing power, but that's how inflation can really affect asset prices. So we see that in stocks too, right? So if inflation is really high, stocks are an asset, right? And as long as business growth is sustainable or sustained over at that same time period, the stock value will go up. Not necessarily because it's a better business, in 10 years than it was today. It's just that inflation has actually affected it. And so anyway, so that's how inflation can affect asset prices. And then we've got business growth, right? And that's what typically people concentrate on is business growth leads to better profitability. And as business growth rises, stocks typically go up in value because everything's accelerating, right? And then as business growth slows or as credit starts to contract, um, then we end up seeing less purchasing of assets and we end up seeing stocks starting to roll over. Like in 2008, we even saw that in COVID, although it happened really fast in COVID. Like historically, that was extremely fast. That was almost like, 1987 level fast, hitting circuit breakers and things like that, just because assets were starting to be valued at their economic or their growth rate, and it was significantly slowing. So growth was slowing at a historic level, and money managers were selling out as a self-preservation tactic. And so that's typically what happens to assets during those times. And we can play off of those relationships, right? As assets start to drop, the Fed typically intervenes. If they don't intervene, then austerity will eventually kind of stop things. Um, but we can also play off the fact that as assets are dropping, the dollar is actually increasing in value, right? And so we can invest in deflationary products and things like that to offset some of our risk and through meaningful diversification. And so that's kind of what that's exactly what the sleep well portfolio uses is it uses those interrelationships through those macro principles of how certain assets affect each other, and it plays off of them to kind of hedge each other off when they're supposed to hedge each other off, and then when they're not to not let them get in their way. So like right now, the sleep well portfolio, we haven't had an exposure in bonds for quite a while, and that's simply because bonds got pushed down into the economic contraction, and as inflation started stalling and then even possibly rising, and then assets started to accelerate, it's not typically a good time to be invested in bonds, right? Now, if we start to see deflationary pressures and we start to see economic contraction, we'll probably start to see bonds go in the other direction as long as there's bond liquidity, which that's a whole nother topic. I might actually write an article about bond liquidity in the US. But anyways, so yeah, I hope that that's a relative decent explanation of just kind of what the relationships are that we use in the sleep well portfolio. And it's really meant to be a long-term type thing. So um, if you're looking for something that really is adapted on a week to week basis, this might not be what you're looking for. But what the sleep well portfolio does do really well is it'll capture those long term macro principles and limit risk. It does limit it to roughly early 10 digit or early double digits. So significantly less than just raw indexing, but it's meant to be an index alternative for just the everyday investor.
It lets you sleep well because you're not getting creamed on these big market moves.
Yeah, yeah. I mean, that's the one thing that so I'm an options trader, and I trade even VIX products and things like that. And you know, I I want to store a certain amount of my wealth into assets, right? And it's like, well, what's the best way to do that? Well, it's just hold cash is just a bad situation. To just buy stock, then you've got to take this massive risk. So even if I just index it, that's just a bad situation. And then a 60/40 portfolio is pretty trash. And then and then I'm like, well, risk parity, right? And so that marched me down the road of Ray Dalio and risk parity. And the problem with that I had was its static allocation of bonds.
Hmm.
When you're using 60% of your portfolio or 55% of your portfolio invested in bonds in an environment that we've got right now, which is hugely is just a really low bond relationship, very
May as
or
well
bond.
just be in cash, right?
Yeah, exactly. And on top of that, it's very similar to like the late 1940s in the bond world, right? And so what happened after the 40s? Bonds drew down like 45% if you were invested in bonds over the next 20 years. It was the worst asset you could hold over the next 20 years. So why would I want to have that in one of my portfolios as a static relationship? So that's why I ended up creating the Sleep Well portfolio was actually really selfishly out of my own desires for how to store cash. So anyways, and then talking to actually I was talking to Tim Pearson, and Tim was like, man, I think some people would really love this, and I'm like, well, I mean, you think so? And it just started to turn into, okay, well, let me, if people are interested, let's kind of test it out. And then all of a sudden it's really, I mean, a lot of people have really benefited from it. Obviously we've had a really good time in this environment. As things adapt and change, we'll do that too. But it's really I'm glad it's helped out a lot of people, and people have had interest in it and use in it. And so I'm just really grateful that I could add value to some people's lives. So
Well, and it's doing a great job. I mean, up another 1% or actually a little bit more in the last week. So yeah, nice job. Well, thanks, Wayne.
yeah,
A nice detailed explanation there.
yeah, thank you. Thanks for asking me some good questions. You always do. And yeah, I love this new page. So I think it gets the point across a little bit easier and a little bit more in a digestible manner. So
Yeah, and it's not that expensive compared to other things you can buy for investment advice. So if you're curious about it or on the fence, just try it out for a month, and if you don't like it, you're not out a lot of money. So it's a lot of people once they get in, they don't want to leave though. So they're having good results. And I know you said you were talking to Tim, and Tim's here. Have you guys made any progress on the option stuff, or is that still kind of on the back burner?
Well, no, we haven't. It's still on the back burner.
Okay.
But, we are thinking about one other twist on it, which Wayne, I need to talk with you. I've actually worked on a bit. We need to talk, but involves doing some directional stock trading based on some sleep well stuff, and I'm excited about that. I think that'll work, and that's where we stand.
Would that be long only, Tim, or that would be long and short?
Well, what I think I'm going to do is amenable to being long or short. It isn't necessarily an options deal, but if it was short, I think I would do it with options, you know. But uh, I figured, you know, for years I've had in my mind, if I did directional trading, which I hardly ever do, but I might do a little bit more of it. I have a set of technical indicators I use on the particular stock that I would use it for, and I get signals for going short as well as long. And we're going to tie that into sleep well, I think, and use that as like a macro guide, and it should be cool.
Cool.
So
Yeah.
I probably, without the sleep well guidance, I will probably make my first couple of long trades tomorrow. So we shall see.
Sorry, I couldn't see the my chat. Okay, now I can see it. Oh, and Rich asked about how do we invest in the sleep well. Well, pretty simple URL. It's just aramir.com/sleepwell. Let's put that in the chat. And what else did we have here? MacroTrends historical data chart from Thomas Byron. Did you pull that up yet, Wayne?
I'm actually looking at it right now, but you're pulling it up too. So
90-year historical chart. Okay, that's good data.
yeah, always good to see some things in here, and I guess what it's just kind of saying is just certain things that you can pull up and look at, certain recessions.
This is about the time that I was trying to get a job as a runner at the CBOE. The market had come down and nobody was hiring, so I tried twice, struck out, and finished my degree and flew for the Air Force. But
Oh, it
kind of
looks
funny.
like Thomas was saying you can adjust for inflation
Oh, nice.
just with a click. So yeah, let's see. Just to kind of show
Let's
that.
see.
Yeah, there's inflation adjusted. So it looks like you're already inflation adjusted.
Oh yeah,
So yeah,
nice.
I mean, you can see just how much inflation definitely, I mean, for real purchasing power, I mean, look at what was it in 2000? If you scroll down just a little bit, I can kind of, yeah, what is it? The 80s? Is that the 80s? No, it's probably
Here's
it's
2000.
probably the 70s,
That's
1970.
82. 75 is in here. Big
Yeah.
drawdown.
So I mean, that's 10 years of of dealing with a huge drawdown, inflation adjusted, which is and what was happening at the same time period is the Federal Reserve. I think this is Bernanke. Is it Bernanke that did it, or was it Greenspan?
Uh,
Anyways, I can't remember the guy, which one it actually was, but he was sitting there just ratcheting interest rates. I mean, just people were just screaming. Wall Street was freaking out. They were just like, "You can't do this," as he's just cranking interest rates. I think we got to a high of like 15 or 17% on
I
the
think it was more
federal.
like 19.
Oh, it was brutal, right?
It was
But
in
I
the
mean, they,
70s. Yeah.
yeah, it was just completely runaway inflation. And if you were invested in stocks, like stocks were actually, doing okay, but the inflation metric was just insane. Um, and you had no safe haven, right? So you had inflation going up, but then at the same time period, bonds were being just ratcheted up and up and up. So if you were ever long in bonds, you were just getting annihilated, right? Because new yields were always better than what you were buying, and so they were just constantly pushing your prices down. So if you were holding bonds, long term, you could get some decent yield on them. So anything like with expiration, like an expiring bond ladder or something like that, would be okay. But man, I mean, it was a really challenging time as far as like just the general 60/40 portfolio that's constantly being rebalanced. Um, and then but there were things that you could invest in. So, like actual hard assets and stocks were actually at least taking care of the inflation, which was, you know, at the time they were measuring it to be, just crazy amounts, 10% and things like that, 8%, just these runaway inflations. Um, you know, People are like, oh, we're going to get another one of those, right? I don't know. I definitely don't know the future or anything like that. Definitely, I've had a lot of questions of, what are my thoughts about,
Hyperinflation.
yeah, and I've written a couple articles about hyperinflation and inflationary environments and stuff like that. Um, the thing about inflation is you've got two aspects of inflation. You've got asset inflation, and then you've got relative inflation, right? So asset inflation, where we take like a hard asset, so something like gold or
Or your
land,
Big
or
Mac.
yeah, or the Big Mac, right? Yeah, exactly. And just it just the dollar just loses value, or whatever currency loses value, to so it takes more of that currency to buy that asset. But then you've got this relative inflation, right? Which is, well, I'm devaluing my currency, but and printing money, right? But what are all the other countries that work in the same financial system as me doing? Well, if they're devaluing their currency at a rate similar to mine, then we don't actually have inflation in the system, right? We just have inflation in assets, and that's a totally different relationship, right? And that's something that can be kind of played off of, because then we have just a general global inflation as the currency wars kind of go, and um, it can really buoy hard assets. So like we use gold in the sleep well portfolio for that, and it's not always a perfect proxy for inflation, especially as gold's supply and demand pressures get a little bit overdone or underdone. But it does do a really good job over history, and as it even recently when inflation is rising, but not necessarily when just like raw inflation is high. So yeah, uh, big long thing. But I love this graph. Thanks, Thomas, for sharing that.
Yeah, I remember I was when I was flying tankers for the Air Force, I was on temporary duty to Incirlik Air Base in Adana, Turkey for about 6, 7 weeks. And they were at the time, let's see, that was early 90s. They were having like 10% a month inflation. So
Mm,
they, I forget what the exchange rate was. It was like $1 was like 80,000 or 90,000 Turkish lira. So
mm,
all the vendors off base, like you go get like dinner or something, it would be like, $2 for dinner. And they wanted
mm.
you to pay them in US dollars, not in their currency.
Oh, so yeah, Thomas had just said, look at this. So you can actually do it by president. You can look at the returns by
Oh
president.
yeah.
So that's actually funny. You can go down there and click on each president and just see, hey, what was their growth? Now, this isn't always a perfect, this isn't always like a fair representation. So I studied behavior in college. So there is a little bit of a cause and effect relationship here. Like, at least this is my theory. So it's not that I'm right or that I know everything, but it's just that, um, it's ironic that this is there, and it's just something that I've seen, right? So when economic times tend to be a little bit more difficult, and there's some credit crunching because of previous stimulus from other administrations, right? And the Fed then needs to tighten credit, and that creates a business cycle tightening, right? Then that tightening leads to a relatively difficult time economically compared to the previous administration. So then what ends up happening is that administration has to deal with that, and it makes them look bad, even though things that they're doing can help. So I'm definitely not saying that I'm necessarily like a Trump fan or anything like that, but you know, Trump was putting a bunch of money back into the system through like tax breaks and different aspects, right? And he was spending money in the system, and that's normally an economic stimulus. But at the same time, as he spends more money and has more, uh, fiscal policy that's creating economic growth, then what that does is that creates inflationary pressures. And then then the Fed says, "Hey, great, we have to keep our inflation at like 2%. So yeah, keep growing with that economic push, but then they're going to ratchet up interest rates, right?" And then that's when Trump was starting to like scream. He was going, "Hey man, why are you doing this? You're killing the goose, right? Like we're trying to do all these good things and you're creating a headwind for us." And that's because of their mandate. And so anyways, so as that business cycle kind of progresses, I've definitely seen a pattern that when economic times are more difficult, we tend to vote Democratic, because Democrats tend to their political views lately have been more towards, we will give out things, kind of like the I'm going to give everyone free lunches, student president type thing in high school. And that tends to spur a lot of, yeah, for the impoverished and the people that have really been hit hard by the economic contraction. And so that typically motivates that political group to go vote more. And so then we end up getting a Democrat and president, or in office, and then that ends up leading to the business contraction actually playing out its role and the Fed starting to stimulate again. Just it so happens to be that there is also a Democrat in office, right? But it would actually happen probably regardless of whoever's in office. And sometimes we do get a second term of like even a Republican that does that. But it's just an interesting dynamic that's played out over history of quite a few times that in an economic contraction, a Democrat actually gets voted into office.
Oh, interesting.
Yeah.
Well, I know people do vote with their wallet.
I know I do. Dang it. I hate that I'm human. Not really. Yeah, this is really cool. This is a good little graph. Yeah, it's fun.
Yeah, it's a nice page. I'll put this in the on the recording for the description. Let's see. So I guess let's see who else is here. I know Tim, you're still doing box cars. How are those working out?
I didn't do any last week because I'm trying to only do them a bit more when we have a bit of a down day. I was doing them no matter what,
Mm-hmm.
just adjusting my initial delta a little bit, but I'm kind of going to try to back off from that a little bit and just do them on down days. So I'm hoping, I really would like to get one on tomorrow, but we shall see,
Well, it looks like futures are up 20. So at this point, it looks like tomorrow might be another update.
Yeah, right. So they'll probably let me get my my long trade on and my covered calls, but we'll see. So I don't know what to say, but that's what I'm doing. Dan reviewed his box cars about 2 weeks ago in Trading Group 1 and did a good summary of what he's doing. And I like a couple of the things he's doing that are different to help control the delta. So if I open them, and I probably won't be able to stand it, and I'll open one anyway. But if I do, I'll get the delta.
Make it a smaller one.
Smaller and 0 or something, instead of positive 3 or 4 or something like that.
Yeah. Makes sense.
Yeah. So.
Well, it looks like Bruno might be here. Is that you, Bruno? BV?
Yes, it's me.
Oh, hey, Bruno. Nice to see you or hear you.
Hi, Tom. Yeah, it's a day off, so I thought I would join and listen to DG1 for a change. Yes.
Yeah, it's been a while. So how are things going for you? And are you still in Barcelona or are you up in France now?
No, I'm in Barcelona. Yeah, life is pretty good. I mean, we are not too restricted. I mean, of course, we're all a little bit depressed. You know, this COVID thing is weighing on us, all of us. But overall, yeah, life is still pretty good here. Too much work, but
So what are you doing now with the firm you're at?
Well, I'm trading a fairly large account. I'm still trading Rhino style. No, it's doing okay. Of course, the market is a little bit frustrating, but because of the volatility gyrations, I mean, it looks like the VIX is falling now. I mean, it's it's fly by sight. I mean, it's very difficult to make sense of this market. Yeah, but otherwise, I'm doing okay. I mean, maybe I can share my screen.
Oh yeah, let me stop sharing mine. Let's see and make sure that you're allowed to. Okay, now you should be able to.
Where is it?
And then whatever happened with your software project?
Oh, the French version is out this week. I'm still not quite happy about all the features. It's more of a beginner's type of platform, but that's okay. And I'm going to be working on oops, what am I doing? Share screen. That must be this one. Yeah. Can you see something?
I do.
Okay, so that's my April type of Rhino adjusted for bullish and fairly high vol. So, I mean, for those, the Rhino, I mean, there is a setup and then you deal with it, you manage it. But, and some would like to stick with upper longs being just above the market. And I stick to something which is also part of the overall principle of the Rhino, which is basically a flat delta of a very large range. But because with a high vol, I don't want to start with a positive delta. I start, and of course with high vol, we get better pricing. So basically my setup is usually quite a bit more OTM. And basically the upside risk is nothing generally. I've got, let's say March. I mean, this is Friday's close data. I don't have any data from IB today because I don't know.
Oh, market's closed.
Yeah, but I mean, I should at least get Friday's close, but I mean, I get nothing. So I had to go to historical data. So that's. I mean, it's not a very, very aggressive type of trading. I mean, as I said, I start pretty much OTM, and if the market keeps grinding up, I would say maybe some elements of the RTT, and I also check the IV convexity to put on some CCS. I don't know whether I would have IV convexity on IB today. Probably not. I don't think there's anything today. So I check where the IV trough is, and I place my CCS above. And when it gets near the, I think I posted the IV convexity thing on my. Yeah, that's the one. That's the one I posted on Friday. So I check for February. The trough is around 4,000. For April, no, that's Feb. Sorry, March is around 4,200. So unless you are convinced the market is going to reverse, then you could place your CCS on the left side of the trough. But I'm always conservative, so I try and place it on that side. And by doing that, also, I don't get caught when the market goes up. I mean, of course, you can still, like I remember around the elections, there was that spike up on the price in news, and so the market just shot up, and I got caught, and I had to roll my CCS at a loss. But generally, for example, now when the market grinds up, I'll start rolling my 4,200 CCS on March. and it doesn't cost me much really. And I even pay for it with a PCS. So it's a kind of a risk reversal, but risk reversal where I check where this IV convexity is. So that's what I'm doing. So basically, it's a very conservative type of management. Incidentally, although that was not the motivating factor initially, by placing my trades, my combos pretty OTM, pretty much OTM, and because I trade portfolio margin, because I've got a fairly large position not to trade. Portfolio margin looks at what the market would be, where your position would be at minus 8, 10, 12%, and basically I'm covered probably like 20%. So from a portfolio margin perspective, this one still for those who remember the Rhino, it's maximum 25K per cycle and maximum 37 to 40K, including overlaps. But now in portfolio margin, I use very little margin. So my trading objective per cycle is about 2%. So for this cycle March, I will try and get $800 to maybe $1,000, which on 40K is about 2%. But on portfolio margin, by just pushing a little bit, at the moment at leverage 1, basically Reg T type of margin, I'm using, calculated back into portfolio margin, I would be at 15-20% margin to equity ratio. So I can push. So basically I get a better return on equity by pushing the margin a little bit more. That's what I'm doing, because really if I stick to Reg T, I'm using only, as I said, 15 to 20% of my equity. So it's very conservative, and I wouldn't say like some people who trade STT type or other trades which are definitely crafted for portfolio margin optimization. This is not the main factor, but it's quite interesting that using so little portfolio margin, I can actually double up my positions. So Reg T, I aim for 2%, and portfolio margin, I aim for 3-4%, and my boss is happy with that.
There were a couple of questions. What software are you using for the IV curve for SPX?
Either my own program, SOAP, or I get it from IB. There's a page on the TWS. You can call up option analytics, and you can get vol surface, vol skew, all those things. And I suppose I'm out of touch with TOS, but I'm sure you can get that the IV skews there as well.
And Rich asks, what's the performance of the Rhino in the past few years?
Reg T margin 1, last year was 12%. So it's not that great, but that's okay. Considering that we had a difficult year in March, April, that's okay. It's all a matter of the objectives, what the guidelines I'm given, and I have to be conservative on a week-to-week basis. Basically, my NAV is calculated every week, so that forces me to, maybe for some people it would look like over-adjusting a bit, but I have to make sure that my performance is very, very stable. So basically my performance that is asked of me is 15 to 20% a year. That's all they're asking for, so that's okay.
And then Thomas says, looks like the Rhino lost the horn.
Yes, it's lost a horn for the main reason that I start OTM. So basically the scaling in rule has disappeared. And also when the market runs away, you don't have any time to let delta build up and then start hedging. So, the second horn to me is not applicable in this type of market, bullish, fairly high volatility. I wish I could be, I mean, it's also a trading style. I mean, I could definitely try and put more money ATM, but you know, the market moves too quickly and I've got too much to do. So I don't want to just too often. I already do a little bit of micromanagement to keep my NAV as stable as possible. But no, I don't want to trade more actively, basically. So this is, again, Reg T 2%, I'm happy. And as with a leverage 2 on portfolio margin, which is still okay. I mean, as I said, based on Reg T, my margin to equity ratio on portfolio margin is less than 20%. It's more like 15. So I can push up the number of tranches I put on. So that's doesn't change my trading style. It's I actually like it this way. If volatility as per VIX goes back to long-term average, which would be maybe 15, 16, 17%, I would naturally go back to more ATM structures, and I would have probably time to let delta build up and start hedging. But I don't think it's applicable right now. It's all a matter of managing by the Greeks. Another thing I check also quite frequently is the Spx Vix correlation. There has been gyrations. There have been gyrations lately. So at the moment, the Spx Vix is back to minus 70%, which is its long-term average, so that's okay. But sometimes you see the correlation going berserk. So that's why now when the correlation is good, I tend to spread out my Vega risk, and I would rather put more negative Vega on the upside. So by putting more Vega on the upside around here and checking my IV convexity, I don't have too much trouble either on the up or downside. I mean, this trade, there was that GameStop incident like 2 weeks ago. This combo, I mean, this cycle, I didn't do anything. I didn't have to adjust. I didn't do anything. I could probably have taken advantage of the pop and put more into the trade at the time, but I didn't. But no, I mean, it's fairly easy. I don't want to be stuck to monitoring my trades all day. I've got too much coding, research, teaching, all sorts of things. So yeah.
And Thomas asked if you compared the Rhino with a simple iron condor or unbalanced iron condor.
I'm sure it could work, but in my experience, the broken wing butterfly combos are more resilient on the downside, at least initially. But sometimes I give up the first horn and I actually turn it into an unbalanced condor. Indeed, yeah, that can be done. Yeah. No,
and
but
then
yeah.
Oh, go ahead. Oh, I was just going to say, do you guys have any plans with the software to release an English version?
Yeah. I mean, that will come. That will come definitely. But I mean, my friend has started recording videos and everything, but it's going to come with English subtitles, and I mean, it's still way too much French for my liking. And also, it looks good. I mean, the user interface is pretty nice, but it's, for example, he hasn't implemented vol surface, and I am very, very finicky when it comes to volatility behavior, the vol skew, the convexity, the vol surface. So there's still quite a lot of coding to put in it. So as a beginner platform in English, I would say probably next month or next 2 months.
Oh, it's pretty soon, really.
Yeah, it's out now in French. Yeah, it's and the good thing is that maybe it's too much integrated into IB, but it does a lot of nice things as well. Like you for example, if you have a lot of options on different underlines, it will automatically collate all the informations and rebuild combos automatically. So in terms of IB portfolio management, it's definitely superior to anything I've seen in the market. So it has good, it has some good features.
Is it limited to IB at the moment?
Yeah, and it will be for a while. I mean, I can't see. I mean, it's the same for my SOAP software.
Right.
You know, you get stuck into the nitty-gritty of an interface. So, and to be honest, I don't think. I mean, you get a good platform for free with TOS. So I don't think many TOS users have. Of course, if they are into backtesting, they sometimes go for OV or one, but I don't think the market is large for TOS users. So it's definitely going to be more applicable to Europeans, which generally trade on IB.
Yeah, I've seen less and less OV users. I think most people have moved to O&E at this point.
Yeah, but it's on one you can't try to trade futures. So that's one thing that's even on IB. I mean, if I go to,
I thought you could.
well, you can model them, but you can't send the orders through.
Oh, I
to
see.
IB.
Okay.
Yeah.
Yep.
And if you trade on the euro,
6E.
Oh, sorry, 6E, not E6. No. Then the modeling is absolutely wrong. I mean, of course, it's no data. I mean, there should be data today.
It should be.
It should be.
Oh, there it is. It's just late.
Yeah, yeah.
Okay.
At the moment, we only on the, because both SOAP and the new platform can trade forex options, but because you can get confused with so many trading classes. So at the moment, we only allow the EUU or for euro. I mean, the 6 major pairs on monthlies. But if for example, I want to put on, I mean, look at these figures. This is completely berserk. So, I mean, the modeling for forex options doesn't work on one, and I can't remember whether that works on OV, but you see your T+0 doesn't even cross the 0 line. I mean, it's, yeah. So that I fixed in SOAP, and that's so the functionality will be integrated into the other program very soon. So there will be a few gaps, a few niches where my algorithms will be of interest, because you can't, unless they fix it. I mean, on one, you can't trade forex options.
Well, when your software is ready for English users, let me know. We'll set you up with a roundtable.
Yes. Yeah, I mean, my software is working fine. I know that, of course, I did it for myself initially, and I am not a big proponent of backtesting. So for those who want to do backtest, I'm sorry. I mean, I trade by the Greeks, and I do my macroeconomic analysis, the volatility analysis, and everything, but I don't do any backtesting. That's me, and it's also that historical data cost a lot of money. So, I mean, it's okay for myself, but if including redistribution rights, I mean, it's an arm and a leg. So maybe in the future I will add backtesting. I mean, yeah, I mean, when you buy or subscribe to one or option view, I would say that probably 50% of what you're paying goes into historical data. That costs really a lot of money. So as you can see, the forex options doesn't work, and not only that, but like for ES, you can't send it. I mean, actually, the box has disappeared. Generally, you have a box here to send to IB, and it's not even there. Yeah.
Oh,
so
people are always interested in an alternative.
Well, it's going to be an interesting alternative that my SOAP software is probably going to be free for a long time, because I don't have time to provide support and all those things. So there will be my software will be free. I mean, maybe I will set up a Patreon or some other way to be rewarded, but I'm not going to turn it into a commercial software, at least in the beginning. Maybe if I team up with someone who can help me with that, because I already have a full-time job. So maybe in a year's time, 2 years' time, if there's interest to take it to the next level, we'll see. But in any case, SOAP will be free and will remain free for a while.
Well, fantastic. Well, Gabby and I are flying back to the U.S. on Thursday, and we're planning to return around end of May, early June. So if you're up in northern France about then, it'd be great to get together again.
Yeah, we couldn't see each other last time around Christmas, but
We're
yes,
still here.
Yeah. No, I mean, I go back to France to see my old parents every 6 weeks, so I'm sure we'll make a plan. Yeah.
Okay, great. Well, we'll keep you updated on our plans, and we'll make it happen.
Cool.
Oh, and Rich asked, how do we get access to the latest version of SOAP?
Well, the best is to connect to my own Slack, the Rhino Slack. I've got a channel for SOAP.
Do you have a URL for that?
I mean, send me an email on bruno@aeromare.com, and I will send an invite.
Yeah, that still works. It should be easy.
I'm sure it does. Yeah.
All right, great.
Okay.
All right, well, thanks, Bruno. Great
Thanks,
update. Nice to see you. Good job trading, and we look forward to hearing when your English version is available, and I'm sure people will be interested in it.
Cool. Sure. I will let you know.
Okay, and thanks, Wayne. Really great explanation on all the economic stuff and the market commentaries and what's moving the markets. I really appreciate that. I did want to mention a couple other things, or at least one. Andy Jordan, I did mentoring with Joe Ross years and years ago, and Andy, he's German, but he lives in the Caribbean, but he's a futures trader, does pairs trading. But we're going to have a talk tomorrow. He's thinking about a trade alert service with Aeromere. So Joe's getting older. I think his business is kind of fading out a little bit. So Andy wanted to do a trade alert service. So we're going to talk about it. But he does pairs trading with futures. It is very safe, and we'll talk tomorrow and see if we can set something up. But there's no roundtable this week. Thursday I'm going to be traveling, so anybody with extra signal, I'm going to be on an airplane most of the day or in an airport, but back on Friday. So hope everybody has a good holiday, and thanks again for everybody for coming. I know it was a slow day, but maybe a little more relaxing with the market closed. So we'll see everyone next time, and have a great day. Thanks, everyone.
Thanks, Tom.